Good evening, everybody. Thank you all for joining this panel this evening. And more importantly, thank you all for joining this Maximum India conclave over the last couple of days. This panel that we have put together is around liquidity events and exits. Establishing an exit or a liquidity event strategy is usually not the first thing that an entrepreneur thinks about when they are starting a business. However, when it comes time to you need to have a solid plan to ensure that a successful financial future is established for the company and for the entrepreneurs. Also, while raising investments from a lot of investors in this panel, which is the Ps and the VCs and other investors, it is imperative to try and chalk out a plan for a liquidity event so as to provide them comfort on timing and horizons for the company. Of course, all of you would have been told all about the statistics. There has been a significant shift in the quantum of PE and VC exits of late. At 22.5 billion, PE and VC exits in the first half of this year has been more than a sevenfold increase in value terms compared to all of the or either half of 2020. First half also recorded more than $4 billion plus exits, which were equivalent to what got recorded in the last 3 years combined. So, with this exciting backdrop and with the rich experience of this panel, we look forward to have a discussion providing some insights on planning investment exits. Over to you, Vishal. And he does not need an introduction. So over to you, Vishal, to introduce our panelists and as well as start the proceedings.
Thanks, Venkat. Look, as you mentioned, one of the questions around private equity in India, and many of you who are watching this, has historically been around lack of exits. And, I've been around private equity for a long, long time, and that's always been a constant refrain from investors saying, are there enough exits in India? Well, I think that's been answered quite emphatically over the past few years. And in particularly in 2020 and 2021, some of the statistics that Venkat mentioned are just lay clear that fact. We're lucky with us today to have star-studded panel. I mean, both the folks out here, Bhavish and Shashank, private equity and venture capital, I love them because they have delivered exits, returns, and I'm sure all of you as investors will love them as well, and really looking forward to hearing their stories. So let me introduce them very briefly, and they will introduce themselves better. Shashank is the CEO of Global Logic, which is a leader in digital product engineering, which is headquartered in the US. Shashank's worked with multiple private equity funds, and all of them have seen successful exits, culminating in the recent strategic sale of the company to Hitachi in a $9.6 billion deal that really provided stellar returns to both the private equity investors. And of course, we have with us Bhavish Aggarwal. He is the founder, CEO of Ola, the man behind not just one, but two startup unicorns, maybe working on a few others, who knows, maybe he'll give us a sneak peek. He's worked with a number of venture capital, private equity, and sovereign wealth funds, and also provided a successful exit to some of his early backers. He's transformed the way all of us travel today, and really is now building the future of mobility with a view towards sustainability as well. So maybe we will, and we may have one other person join us, but for right now, why don't we kick off really with Bhavish? And Bhavish, you're really the man around the news these days. You've got rumors around a potential listing of Ola. I'm going to put you on the spot a little bit. And the launch of your scooter at Ola Electric. So, I gave a little bit of background, but it'd be super for the audience to just hear a little bit about your journey, about the company. You work with so many funds, and tell us what it's been like.
Sure, Vishal, thank you so much for having me, and Vishal and Venkat, both of you, thank you so much. And hello to everybody. It's great to be speaking on a very interesting topic. Actually, many panel discussions are focused much more on the business side. But this is a very interesting topic, and really excited to be here. So my journey began in 2010. I was an engineer from IIT Bombay, worked for 2 years, and then started Ola in 2010. And I started Ola with basically whatever little savings I had back then. And in 2010, the Indian investing community and ecosystem was still very early. There were hardly any VCs, and there were a few private equities, but the kind of investments were much more in, let's say, more traditional sectors than in consumer tech or the internet. So 2010 we got started. We raised angel money in 2011, and frankly, I tell this many times that the hardest capital I've ever raised is my angel round, because here were a couple of young 25, 24-year-old kids who were basically in the world's view starting a taxi company, right? So this is in circa 2011. But since then, 2012, we raised our first institutional money from Tiger Global, Series A, and that allowed us to scale up our whole goal of building Ola as a large national ride sharing company across India. And at that time, 2012 onwards, we started seeing both. There were a few macro trends happening in India at that time. One was obviously the penetration of data and mobile smartphones. 2012 was still early, but 2015 onwards, it really picked up. Then the other macro trend was the growth of the startup community, and linked to it the growth of the investment community. Right? All of these trends helped us kind of leverage this wave of startups. So 2012 we raised our Series A. Then throughout our journey, then we've been very lucky to work with world-class partners like SoftBank, like even Vishal himself, most recently. Along the way, we've many early investors have sold to good returns, and many new ones have joined the bandwagon, so to say, so that because our goal, our vision is still much ahead of us. And so Ola. Just to summarize, so Ola is a leading rideshare company in India, one of the world's top 5 rideshare companies. And now we're also building a large mobility platform around it. 3 years ago, I also started a separate company called Ola Electric, where we are looking to build electric vehicles in the urban mobility space for the whole world, starting with India. And again, I've been lucky to work with some of my investment partners from Ola itself in the Ola Electric journey. And the kind of I actually believe the investor ecosystem has really matured a lot in India. Returns have also been delivered. Most lately, we've all seen the Zomato IPO in the consumer tech space, and then the Freshworks IPO lately. And also many private transactions. There have been good value creation. So I actually, to summarize, I believe this is the moment for Indian technology companies to really inflect. The Indian ecosystem and Indian companies are at a very strong inflection point, and I think the future will only be much, much more brighter.
Wow, Bhavish, can I invest some more in Ola? I mean, after that speech, I just, but really, that's terrific background. Thank you for sharing that with us. Maybe switching to you, Shashank. It's a different journey. You're based in the US. You've built Global Logic into a just powerhouse in product engineering, which you'll be able to tell that story better. And you work with multiple VC and private equity investors who are based both in India, but also globally. So tell us a little bit about that and what it was like to work with these different investors through that journey.
Thanks, Vishal, and good morning, good evening to everyone. It's actually really a humbling and pleasure to share the podium with Bhavish and Vishal and Venkat. I always heard many of your names. I think, Vishal, we know each other, but it's really very humbling. Global Logic is a digital product engineering services company. What it does is helps some of the leading brands in the world, most of them are Fortune 1000, and try to help them to see the world the way it should be, not the way the world it is today. And in line, we create some of the best, amazing products, some of the great platforms and engaging experiences. Now, in line, we create a new service line, new business line. We work on their revenue line. We don't work on their cost line. We created this company. We're almost close to 1.2 billion plus now. We are growing at around 25% organic, 23,000 designers, engineers, and data scientists across close to around 35 cities around the world. And this is a great journey. It all started with actually 4 IITians, 2 in Washington, D.C. and 2 in Delhi, starting the company. The original capital was raised from Westbridge, from India, from Sumir Chadha. I came in the company when second round was going on in 2008. Company was around close to 50 million. And that is also the time actually we are trying to make a transition from working with technology product companies with the enterprise world in communications and media, in auto and industrial, in healthcare, largely medtech and clinical, CPG retail, and then tech side. Over the next 14, 15 years journey, what we realize is as much as your markets change, as much as your service lines change, you try to change your people, you have to also change your investors because each of them come with a specific agenda. And as you're growing and his ambitions are bigger, you have to get actually different people in the company. So it all started with Westbridge. It actually came further down the line with Apex partners, Shashank Singh and Ron Haldia in 2013. And it further followed actually with going further down in 2017-18 with CPPIB, the Sovereign Fund and Partners Group. And each time there are great exits. I think several times, not 3 and 4 times, but actually almost 6 to 8 times returns in those 5 years. And in the same line, actually, we are all aligned. Management and team is aligned along with them. So we built a great company. I think always the time comes when you try to have the much bigger canvas to paint on, and that's what Hitachi offered. So just about we are going to IPO, and we flipped the card, and we joined the Hitachi family in just 2 months back.
Thanks, Shashank. And just take a minute to welcome Ameera. Hi, Ameera. Thanks for joining us on the panel. Most of you are familiar with Ameera. So Ameera, I'm going to take a minute and introduce you. You're the promoter, managing director of Metropolis Healthcare, leading Indian diagnostics company, which also has a footprint in South Asia, Africa, and the Middle East. Ameera has provided an exit for investors through multiple routes, including secondary sales funded by the next set of financial investors, and also a very successful IPO and subsequent block trades in the market. I've had the pleasure of working with Ameera and Ona for many years. So thank you again for joining, Ameera. Maybe, Ameera, just Bhavish and Shashank were giving a little bit of background on their journey. Maybe you can talk a little bit about your journey in Metropolis, working with various investors and what it is today, just to give the audience a sense.
Oh, thanks, Vishal. Happy to be here, and hi to everybody else on the panel and the audience. Look, I think it's been a great 20-year journey, and unlike probably journeys for some people, or maybe it's not for everyone, mine has definitely been a roller coaster in many ways. Lots of ups and downs, and I wouldn't change it for anything in the world. A lot of learnings in the downtimes, a lot of challenges. Not only from having different investors, different ways of funding, having hostile investors in some cases. So it's been a mixed bag. But overall, I've seen we've gone through private equity 3 times. We first worked with ICICI Ventures in 2006 to 10, and then Warburg Pincus, of course, you guys from 2010 to 15, and then Carlyle from 15 till we went public in 2019. And then, of course, they sold a block trade. And I think overall, I found that we always chose investors not from a perspective of only who gave the highest valuations, but our logic always of choosing investors were the ones who overall, one, were credible, second, were supportive of promoters, and third, who looked at terms holistically and not just value. As entrepreneurs, I can tell you, it's very tempting to just go with the guys who will give you the highest value. But that doesn't necessarily stand you in good stead over long term when you need to give them an exit. Sometimes investors can be painful to deal with, if I can say. And therefore choosing the right partner, even if it's just a financial investor, I think is really critical. And what we always did was really evaluate our partners from a perspective of who can be truly a partner in the journey and add value in some way, even if it's not through strategy or business, but at least in governance, at the board level. I'm very happy, honestly, Vishal, and very proud that unlike the reputation that Indian promoters have generally in India and globally of not always treating their investors fairly, we've made lots of money for our investors, not only private, but even our structured debt investors, our public market investors. And I always say that it's been purely selfish to do that, because at every round of funding, we've had a lineup of investors to come and partner with us because we were fair and good to our previous investors. So, I think it's been very helpful for the organization, I think.
Thanks, Ameera, and thank you for letting Warburg Pincus be one of those investors who got a nice, healthy exit. So why don't we switch gears a little bit, Venkat, and maybe I'll turn it over to you.
So, questions. Bhavish, how have you seen investors help both in planning of exits as well as in helping additional subsequent primary as well as secondary rounds. And as Vishal says, the rumored IPO, how are these people useful in that journey?
Sure, Venkat. I think that's a great question, and I think our perspective, different industries between Shashank, Amira, and myself, we represent very different industries, and especially in the consumer tech world, right, or the consumer internet world, entrepreneurs tend to be very young when they start off. So I was a 24-year-old kid when I started off, right? So we are always looking for learning, and investors have always been a big source of knowledge and learning enhancement for young founders in the tech world, right? Also, since the technology world moves so fast, investors have a great pulse of what's happening around the world. Many of our investors are global institutions themselves, like for example, SoftBank as an example, or sovereign funds, etc. There's always been a very strong sharing of knowledge from across the world, connections, networks, even helping with networks and with ideas on how to raise subsequent funding, and even enabling young founders to think about subsequent funding. Sometimes we as founders and promoters can become very conservative with dilution, and in the tech world, it works in general in a very different way. So investors have been a big source of learning and knowledge enhancement for me personally, and also they've enabled us to be very smart about understanding between good and bad capital, understanding when we should raise, how to compete, how to use capital as a competitive advantage in largely the private markets. We still haven't gone public yet, but as we are now looking to plan for an IPO, investors have been very helpful in understanding the difference between an aggressive price versus a fair price, leaving money on the table for the future investors. And like Amira said, as an entrepreneur, you always have the urge to price maximum, but in the end, you have to be pragmatic and make sure everybody makes money, including your incoming investor, right? So all of those decisions and the thought process for me at least has been in partnership with my key investors, and even thinking of how to raise different formats of capital, especially as we are building Ola Electric. Our partners, investor partners there, have been very helpful in helping us think about different debt capital there, not just equity. Right? Because I came from a tech world, but Ola, our electric business, is a very different manufacturing focused world. So in that sense, I've always tried to build an investor base on the cap table, which is, first and foremost, they should believe in the vision, and secondly, the relationship should be good. We should be able to have a chat. A little bit of fight, friction always happens in any relationship, but in the end, it should end up by in a good way, right? So in that way, we learn a lot from investors. I learn a lot, and I'm sure investors also take away a few things from our growth journey, which they can replicate in other companies.
Well said.
That's great. Maybe Venkat, I have a question for Amira. Amira, you've gone through an IPO. I have two questions for you. One is, you've gone through an IPO, so maybe worth getting your view on how you were supported and what help you got from a private equity investor, and how the process was ultimately helping them exit as they exited with a block trade in the market. And the second is, you also interestingly provided an exit for an investor by yourself purchasing their shares, and provided a very good exit. And you took a lot of risk to do that as an entrepreneur, and it's worked out really, really well, rightfully so. Maybe you could talk a little bit about those two exits, because they are just different.
Yeah. Vishal, 2015 was a tricky time for us. I, as a promoter, I didn't have control on the board. The company was suffering for it, and you guys who were investors in the company were being blocked from exiting, unfortunately. And I was very clear that you had invested in Metropolis on the back of me and my credibility and your ability to get an exit, and therefore I felt my responsibility to do so. And even if that meant taking a big risk, which I did at crazy interest rates, I won't mention them because KKR will kill me. But
At least you mentioned who charged you those crazy rates.
It's in the public domain. Everyone knows. But they believed in us at the time when nobody else would. And honestly, what I appreciated most about you guys was that, at a time when it came to a difficult situation, and I remember I met with Chip and I met with you guys, and I said, look, this is a situation, and you all were very gentlemanly and very ethical in your behavior to partner with the entrepreneur to say, look, let's figure out a way that this works for everyone. And to me, I think that's what true-blooded private equity firms do versus the guys who only believe in the transaction versus the relationship. And that's why we're all sitting here today. So I think that was a very interesting time for the business. And I'll tell you, from a promoter and a company perspective, it was the turning point for Metropolis. At that point, we were valued at about 2,000 odd crores. Today, Metropolis is a $2 billion company. Value. It was a huge risk, but it was a risk that it was a punt I took on myself, but also a punt as much to fulfill my responsibility to the investors. And I often tell entrepreneurs who chat with me about this that, taking money from somebody is not an asset. I mean, at the end of the day, it's a responsibility. And it is our job to make sure we pay it back with the returns, hopefully commensurate with the risk taken. The IPO, again, was done for multiple reasons. One was to give an exit to Carlyle, who was an investor and a fair investor to us. And second, also, because I had taken this debt and I wanted to get it off my shoulders and de-risk myself and the company. And I'll tell you, this was 6 months after ILFS. It was a bad time. It was a negative sentiment. Nobody wanted to invest. There was no deals happening. Everything was paralysis mode. And we took the call to say, look, let's be the first ones in the market and let's break this jinx. And we did that. And we didn't get priced at our fair value. We took a hit. We went at a 25-30% discount to what our expectations were. But again, I think part of being a smart promoter is to look at the bigger picture and to say, look, does this overall help me from the long term rather than looking at anything only at one point in time. And I'll tell you, we did that, and I'm thankful for the decision that we made.
That's fantastic. Thanks, Ameera.
Mm-hmm. Very well put, in the sense that in my own journey as an entrepreneur, I've realized that one will raise capital at different points of time. And some of them will look stupid in posterity, and some of them will look very smart. And hopefully all investors end up feeling good about having invested in your company, and that is a good end goal to have. Moving on, I'll just to Shashank, isn't it? Shashank, with your global experience, you have obviously clearly helped engineer a number of successful exits, starting with funding sources driven out of India. And I know Sumir, and he's an amazing entrepreneur, in my opinion, and driven out of India. So funding sources driven out of India, and finally to a Japanese investor or a partner. Tell us a little bit about the differences in those processes and any learnings that you can potentially share with the audience on how to navigate and prepare for a successful exit event.
No, thank you. I think I've worked with two set of investors, and I'm sure that everyone in the panel is. I think there is a set of investors which are VCs, which are like Samir Chadda, Westbridge side, or which are like early on with reference to NEAs and Drapers of the world. And then you work with the private equity. And the third piece is now actually the strategic, right? But I think these two are very different. I think what I gathered is when you work with VCs, there's no specific timeline of exit. They are investing in the concept, they're investing in the entrepreneur, they're investing in their passion, and they actually want to go along with you. The discussion and dialogue in the boardroom is very different. It's about whom you are hiring and what price point you're hiring and where you are going and how you are going to use your funds. It's a very different dialogue. When you work with the Ps, right from the get-go, there is an investment thesis. Whether it is with Apax, I worked with Warburg before, so whether Warburg, whether it's Apax, whether it is you're going with CPPIB or Partners Group, there is always a thesis, and that thesis goes between 3 to 5 years, so sometimes a little longer nowadays, right? And the thesis is based on either efficiency or acceleration. Now, for my business, it was always acceleration because market was there, and more we can do is actually going to be more is going to be merrier. So what I realize is when you work with the VCs, you are trying to get the company to make it viable. When you work with the Ps, you're trying to make that viable to truly create your brand and try to get your position in the market in the top 3, top 4, or whatever that market you are trying to go for. So with the P's is a little easier, in my opinion, because there is a thesis in terms of what is success, which VCs that is not defined, and your company is also not defined as well. My personal belief is, I think all the investors, and probably I might be blessed, but all the investors which we gone in, I exactly gone in what exactly Ameera said. It's not because of the highest valuation. A, do they believe in my cause which I'm trying to pursue? They are passionate about it. Do they understand it? It's not just the dumb money. It's the real money which they're trying to. I always say that the money has actually a smell and a color which is very different for each. So do their value system tallies you. Beyond actually the boardroom, can you have dinner and lunches with them? Will you enjoy with them? Okay, and you can talk openly with them. They'll allow you space. That is quite important. And when we do that, then it's between management and largely CEO, but management and the private equity, can they actually work together in terms of those exits? The last point I will make is, I think there was an event actually over in the Valley, and once I made a controversial statement saying that many of us actually, when you are entrepreneurs, we always try to plan for what if things don't work. But very few of us plan for what if we are tremendously successful. And the second part I took it, because if you really ask me, what if we are tremendously successful, will not structure the company in the country or in the region. You might be in Cayman Islands, not in US for that matter. Correct? So I think it's very important to start thinking, if you are going to be successful, then what kind of partners we want, what journey you are going to take. And in line, you give those exits. There are times actually you have to narrow that path. I'll give an example of my own life. Is when Sequoia, and Draper, both of them, all three of them came before I started my tenure in Global Logic. They came in 2006 to 2007, I started in 2008. So by 2013, they wanted to have exit. And their preferred path would have been selling it to either Cognizant or Accenture. And we would have sold that company that time for around 450 million. You can imagine this. Right now, we sold it at 9.6 billion, right? Just like what Ameera said, actually, how you go through the phases. And it was me and my management team's call. What if we give you the same valuation, but we want to keep the control of the company? And that is the reason we went with Shashank Singh and from Apex. And that paid off in the long run. But those are the investors which sat together with them and say that we understand. You want to actually grow the company. You are just building the platform, and the real benefit is further ahead. We need to stop our journey over here because our funds are expiring, but we are willing to work with you to go with the partners which you are going to select. And we can get our returns. And this happens every particular time. The last piece I will say, the biggest challenge for us, or biggest decision-making point for me is March 2020, when it just happened, 21. And the interesting part over there is we're all ready for going public. We did actually all our road shows. We actually have Blackstones and Fidelities. Everybody signed off on that. And there was an offer on the table from Japanese saying that we can buy you at X. And that is the time actually the burden comes squarely on CEO. Because investors say that CPP and PG can say we can go for 10 years, even in the public market. You're all ready. Within 2 years, you can flip it to actually public company in that line. But then you have to make a call saying that, am I getting the large enough canvas for my clients, for my employees, for myself, to paint actually the picture, just like Sistine Chapel, which Angelo did it, right? Not about Pieta and David's statue, what he did. Do I get it? And is it worth it? And I have to live with it. And some of my actually executives said that, Shashank, we want to ring the bell, and you didn't let us do that. And some of the executives said it's a smart decision. Time will tell what it was. But I think that is also the time your investor want to support you. So I absolutely agree with Ameera and Bhavish. You need to get the people actually who believe in you, who are with you, and who are passionate about your business.
Thank you.
Maybe one more question for Bhavish, and then I am cognizant of time. We should also open for some Q&A from the audience. But Bhavish, a couple of maybe a two-part question. One is you've got a very different cap table from when you talk about what Shashank's talking about or what Ameera's talking about. Many different investors, different horizons, VCs and PEs in there. I don't want to call it a khichdi because that would be very rude, but since I'm part of it. But how do you deal with some of these different things when you're planning exits and you have different people coming to you? And the second part of that, which I'll throw out at you as well, is talk a little bit about pre-IPO, because I know you can't talk a lot about IPO, but right now there's a lot of interest in pre-IPOs, right? And you're seeing some of that come into Anola. So maybe you can talk about both those.
Sure, Vishal. So I think a common underlying thread across both is that we are a technology company. And technology is all about disruption, change, and growth. And technology companies, as a result, are all about top line growth or revenue growth. And that's what a pre-IPO investor values in a technology company. That's why a VC invests in a technology company, and that's why many technology company cap tables end up being khichadis. So, right, because when it is all about growth, revenue growth, penetration, increasing adoption curves, you need capital. And many times I've heard people confuse capital efficiency with profitability in the technology company's growth. And it's all about capital efficiency, in my view, and revenue growth, not profitability in the early parts of the journey. And that has been proven true across the world multiple times over by Amazon, by other companies, multiple times over. So as a result, all technology companies and founders end up getting a wide variety of investors to support them during the journey, starting with angels or seed funds to VCs, Series A, B, C, and then that's after that maybe a private equity firm comes in or a sovereign wealth fund comes in or crossover funds. And the interest in Indian technology investing has just grown so rapidly in the last 2-3 years, especially the last couple of years, right? So that's it's actually a problem of plenty these days, and a young founder, I'm sure, gets confused who to take the money from, right? And each of these funds have a different horizon on exit. They have a different horizon on or different perspective on growth and different perspective on value creation. So it's very important that you pick the right partners. From our side, we always decided to work with investors who have a good experience with technology investing in general, and more particularly, like Ameera, Shashank, everybody have said that with whom we could share a good relationship with. We don't need to agree on everything, but who we can share a good relationship with. We can brainstorm ideas and we can learn from. And as a result, we've been able to manage a very broad cap table well. And along the way, as different exit needs came up for investors, we were able to give them exits also. Right. So that's one of the core differences, I believe, in the technology world, where you really are focused a lot on growth. And even when you look at today, the interest in the India market, India technology market today, it's a function of multiple things at the macro level, right? It's a function of the increased penetration in digital happening due to COVID. It's a function of maturity of the startup ecosystem in India. It's also in some ways a good outcome of what's happening on with some of our northeastern neighbors, right? So, and we see all that kind of interest coming into pre-IPO rounds. We are also in a similar situation where we're getting a lot of interest from a wide variety of funds, funds who many of them have never even invested in India before, but are top quality funds. So it seems a lot of interest in India has arisen in public market funds who are also crossover and have never looked at Indian companies before. So it's in a way also the job of the entrepreneur to educate the investors about your company's journey post IPO at a pre-IPO stage, as well as in these days also educate them about the Indian opportunity more broadly and more generally speaking, right? And so I think each founder will each promoter will navigate this pre-IPO journey a little differently, but it's very exciting to see that the ecosystem has broadened and developed so much.
Got it. Makes sense.
Before we go to Q&A, Vishal, I thought I'll ask you a question.
That's not allowed. You're going outside the rules of this panel, Venkat.
Since you are giving Ameera and Bhavish and Shashank a hard time, so why is it that PEs have not gone towards, because trying to find very high quality companies which are growing nicely should be getting tougher, right? So how are P's thinking about elongating their horizons? Because this seems to be multiplying actually quite well, right? So in the sense that if the same investor stayed with Shashank and did not have a need from their LPs or their clients or for an exit, I think this outcome would have been fantastic, right? And similar would have been the case with Ameera as well as Bhavish.
Gosh, Venkat, thanks. I really appreciate you throwing these curveballs at me on the panel, particularly with Ameera, Bhavish, and Shashank smiling and waiting for the answer. But the truth is, I've said this publicly before. Our biggest mistakes at Warburg Pincus have been our exits, not in our investments.
Yeah.
And I think we've always valued our relationships with the companies, with the entrepreneurs, with the management team. And in every horizon of a company, there comes a point in which the management team or the entrepreneur says, this is a good time for you to exit and for me to refresh the cap table and bring on that next investor. It may be because someone brings in a different capability, a longer time horizon from there. How are we dealing with it as funds? As you know, as private equity funds, we have a fiduciary duty to return capital back to investors, generate returns. And while holding periods can get elongated as you can feel comfortable generating higher returns, I think there are different types of funds that are being raised by private equity funds, the TAC funds, the long-term hold funds, which have a different corpus and can therefore invest over a much longer period of time and are targeting multiple versus just IRR. So there are different products for LPs in the market that are out there and that have actually been gaining a lot of traction to help solve exactly what you're saying. The other piece is really, as you're seeing really, really good companies, you're seeing private equity investors in exit from one fund to a new investor, but rolling over a portion of their investment. Again, allowing them to continue to play in that story and continue to generate. And I always say, if you've got a great entrepreneur, and we have 3 terrific entrepreneurs on this panel, and you've got a company that you already know, the risk on that is hugely lower. So why go look searching? You have to search for other things as well. We all do. That's part of our. So that's how I would answer your question. I think it is more of that. It's more available, Venkat. And I think the truth is, particularly in India, I think if you're not patient and you don't have that long-term view, you're likely to get cherry-picked on the bad side of things.
Thank you. Questions?
I see we have only a minute left.
Yeah, exactly.
So I don't know if there are questions or if I guess I see there's a question box here. Question from Ashley. There are multiple avenues for delivering exits to financial investors. How important are IPOs? And since capital markets are cyclical, how does one navigate through turbulent markets and get the exit timing right? That is not posed to anyone in particular. So anyone wants to take that, or Venkat, given your background, you might be actually the best person to answer it.
I think IPOs are hugely window driven, and that is true all over the world, in the sense that what Ameera has done is an exception, but most of the time good IPOs happen in good windows, and that should not necessarily be assumed as the ideal, always fixated to go towards an IPO is not necessarily ideal for any company, in my opinion. I do think, however, that capital markets price things actually quite well, and it may seem cyclical, and cyclical could be equated to volatile, but in the sense, public market investors and investing has delivered consistent returns over an extended period of time. And so therefore, I do think that IPO should be a good option for companies, but should not be pre-baked in your strategy of exit. At least that is my view.
If I can add something to that, Vishal, the experience I had, like I said, when we went public, it was really not a great time. But what I found is the difference between the private value and the public value was so big that even though we were getting discounted 25-30% on the public market, the choice I had was to go with the private equity player at the time, which was giving me the same price as the public market. But what I focused on was that, look, if I go public, this is only a one-time hit I'm taking, but the rest of my shares will be far more valuable once we are listed, versus if I went with the private at that time, the rest of my shares would not be any more valuable. So I think it's looking at not only the transaction, but looking at what it would mean for the rest of your equity for the next few years.
I think that's a really interesting point, Ameera. I agree with you 100%. Well, it's worked out really well for you. And I know we're out of time. So I just want to thank everyone on the panel for joining. Ameera, Bhavish, Shashank, and Venkat, really thank you all. And it's been a terrific discussion. And I hope I have some of it recorded because you all said such nice things about me. I want to be able to play it again. So, really, thank you, everyone. And
Thank you all.
Bye.
Thank you.
Bye.
Bye.
Take care.